They don't get rich by growing first. They get rich by being trusted first. That's the uncomfortable truth most economics textbooks politely skip. Before factories. Before innovation. Before productivity charts start climbing. Something else happens quietly, behind closed doors, in rating agencies, bond desks, and balance sheets. Credit decides who gets to grow. And who never really gets the chance. Right now, this matters more than it has in decades. Because the global economy isn't split between developed and developing countries anymore. It's split between countries that borrow cheaply, and countries that can't. That gap is widening. Fast. Let's start with a simple scene. Two countries. Same population size. Same natural resources. Similar education levels. Similar ambitions. Country A borrows money at 2% interest. Country B borrows at 9%. Neither has built anything yet. But the race is already over. Because growth doesn't start with ideas. It starts with financing those ideas long enough for them to work. And credit decides how expensive patience is. Here's how the system actually works, without the polite language. When a country wants to grow, it almost always needs to borrow. To build roads, ports, power grids, schools, digital infrastructure. Sometimes just to stabilize its currency long enough to avoid chaos. Borrowing isn't a failure. It's the default setting of modern economics. The question isn't whether you borrow. It's how much the world charges you for borrowing. That price is interest. And interest is not just math. It's judgment. Global investors don't ask, will this country grow? They ask, will I get my money back, on time, in a currency that still means something? That single question shapes everything. If the answer feels safe, money flows in cheaply. If it feels uncertain, money becomes expensive, or disappears entirely. And here's the twist. Countries with cheap credit can afford mistakes. Countries with expensive credit can't. Imagine building a bridge. Country A borrows at 2%. The project runs over budget. Delays happen. Corruption schemes a little off the top. Not great, but survivable. Debt servicing costs stay manageable. Investors stay calm. Country B borrows at 9%. Same delays. Same overruns. Same human imperfections. Now the debt snowballs. Budgets tighten. Currency weakens. Investors panic. Interest rates rise further. The bridge becomes a symbol of irresponsibility instead of development. Same project. Different credit. Very different futures. This is where the story gets uncomfortable. Because we like to tell ourselves that markets reward discipline and punish mismanagement. But the market's memory is long, and its forgiveness is selective. Credit ratings, for example, are supposed to measure risk. In reality, they often measure history. Colonial history. Debt crises from decades ago. Political stereotypes dressed up as spreadsheets. A country that defaulted 30 years ago still pays for it today. A country that never defaulted can run massive deficits and still borrow cheaply, because everyone assumes it will figure it out. This isn't conspiracy. It's inertia. Trust compounds. So does distrust. And once a country is labeled risky, every policy decision becomes more expensive. Raise interest rates to fight inflation? Growth slows, debt worsens. Lower rates to stimulate growth? Currency weakens, capital flees. Increase spending to invest? Deficits spike, ratings drop. Cut spending to reassure investors? Social unrest rises, growth stalls. It's a trap with polite language. Now let's talk about the part rarely shown in explainer videos. The math. When interest rates are low, debt can shrink relative to the economy even if the country keeps borrowing. Growth outruns the cost of money. When interest rates are high, debt grows faster than the economy no matter how responsible the government is. This is not theory. It's arithmetic. If your economy grows at 4% and you borrow at 2%, debt becomes easier to manage over time. If your economy grows at 4% and you borrow at 9%, debt becomes heavier every year, even if spending stays flat. This is how credit decides outcomes before policies even matter. Now here's where irony enters the room. Countries that already have strong economies are trusted more. Because they're trusted more, they borrow cheaply. Because they borrow cheaply, they can invest more. Because they invest more, they stay strong. Countries that are weaker are trusted less. Because they're trusted less, they borrow expensively. Because they borrow expensively, investment slows. Because investment slows, they stay weak. This is not a ladder. It's a loop. And the loop doesn't care about effort. It cares about perception. Publicly, the story sounds different. We hear about structural reforms, fiscal discipline, good governance. All important. All real. But quietly, underneath, credit conditions often overpower them. A well-managed country with bad credit conditions struggles. A poorly managed country with excellent credit conditions survives longer than it should. This is why some governments can print trillions, run deficits for decades, and still be treated as safe havens. And why others face capital flight over budget gaps that would barely make headlines elsewhere. The system doesn't collapse because it's unfair. It persists because it's stable for those at the center. Global capital wants predictability more than justice. And predictability lives where credit is already cheap. Now zoom out. This dynamic shapes global inequality more than trade deals or aid programs ever did. Foreign investment doesn't just chase opportunity. It chases exit options. Countries with deep bond markets, stable currencies, and trusted institutions offer investors a way out if things go wrong. Countries without those features are asked to pay for the risk of being trapped. So capital flows to where it's least needed, because it's safest there. And avoids where it's most needed, because safety is expensive. Even development banks, designed to help, price loans based on risk models influenced by the same credit logic. So the system reinforces itself at every level. Over time, something else happens. Policy choices narrow. Governments stop asking, what does the economy need? They start asking, what will the bond market tolerate? Education budgets get delayed. Infrastructure plans get scaled back. Healthcare investments get postponed. Not because they don't matter, but because servicing debt matters first. And once debt servicing dominates the budget, growth becomes an afterthought. This is how credit decides outcomes before growth ever arrives. Now, to be clear, none of this means countries have no agency. Policy matters. Institutions matter. Leadership matters. But they matter inside a credit environment they didn't fully choose. It's like trying to win a race where some runners start on flat ground, and others start uphill, carrying interest payments on their backs. Same track. Different gravity. And the uncomfortable part? The system isn't broken. It's functioning exactly as designed. Global finance was built to protect capital, not to equalize opportunity. It rewards stability, continuity, and familiarity. Not potential. Not urgency. Not fairness. Which raises a quiet, unsettling question. If credit determines who gets to grow, and growth determines who becomes creditworthy, how does anyone ever break out of the loop? Some do. Through export booms, strategic industrial policy, rare political alignment, sometimes sheer luck. Most don't. They manage decline, or stagnation, or cycles of crisis and recovery that never quite recover. And as global interest rates rise, this dynamic gets harsher. Cheap money is disappearing. The tolerance for risk is shrinking. which means the price of being untrusted is going up. So when we talk about which countries will thrive in the next decade, the answer won't come from slogans or summits. It will come from spreadsheets most people never see. From interest rate spreads. From rollover risk. From who gets patience and who doesn't. Because before a country grows, before it builds, before it proves anything, credit has already made a decision. And the world is living with the consequences of that decision right now. The question is whether the system can survive a future where trust is scarcer, money is tighter, and patience costs more than ever before.